Last week we looked at depreciation methods, and then out of that we started off with the straight line method, and we looked at the example that was there in the handout on straight line method. So before we move ahead, I just run through again the straight line method so that those who were not there right. So under the straight line method, you all can see the board, right? Is the board visible? Okay. So now if you look at it, under the straight line method, I'm talking about the annual depreciation, right? We will go with the shorter form, AD, which is annual depreciation. The annual depreciation is calculated on the depreciable amount into the depreciation rate. Okay, let me repeat it again. The annual depreciation, this is the annual depreciation, and this is the depreciable amount, and this is the depreciation rate. Okay, so this is pretty straightforward. The annual depreciation is the depreciable amount into the depreciation rate. So the only difference comes when there is a depreciation policy. So according to the depreciation policy, in the first year of the asset, that is when you purchase the asset, the applicable depreciation may differ. Which I mean is, now when you say annual depreciation, it covers 12 months. That you know. But depending on the policy, this may change. As I explained to you last time, and I also gave you an example of that kind, where the companies may decide what to do with this asset when it comes to depreciation, whether to charge it full in the year of purchase and ignore in the year of disposal, or whether to charge depreciation in full in both the year of purchase as well as in the year of disposal, or again on the convention of prorate convention. Prorate convention is, in the year of purchase you will depreciate only for the months that you have used the asset or it has been with you during the year. Now earlier the concept was where it says as long as you start using it only you have to depreciate, but now it's not that the case. When you bring in the asset from day one, you have to depreciate it. So the decision whether to use it or put it aside, it's up to the organization. Okay, so when you bring in an asset, from that very single point, you have to start depreciating. So the difference comes with regard to the policy, whether you want to depreciate it from day one or you want to depreciate it only for the months that it was in possession or in use. Okay, right. So if you look at it, the straight line method, it's very simple. You know how to calculate the depreciable amount. It is cost minus residual value or scrap value, and then you have the depreciation rate. So instead of the depreciation rate, sometimes you might be given the useful life. So I have told you how to calculate the depreciation rate, or using the useful life also you can calculate. So likewise, what happens? You keep on depreciating this asset into your P&L. So depreciation is actually known as a book entry. It is known as a book entry. So book entry means there is no cash impact. There is no cash impact when it comes to the depreciation entry, because what do? We debit the P&L. The name can be something like depreciation charge, and you can put it as the P&L account. And the credit will go to provision for depreciation. So I hope I have given this. So this is a balance sheet account and this is the P&L account. So you see, there is no cash inflow or cash outflow. But if you pay for electricity, what happens? You will debit the electricity account and the credit will go to cash account. Cash account. So there it is having an impact of cash. But here it doesn't have an impact on cash. As a result, we call this as a book entry. This particular double entry is known as a book entry. So in business environment, there will be plenty of book entries. There will be plenty of book entries. So when in exams you need to identify, depending on the requirement only, you don't need to identify every transaction as a cash related entry or book entry, because in most of the questions you need not do it. But there is one area where we need to do statement of cash flows. So when you are doing the statement of cash flows, you need to know what are the book entries as far as the organization is concerned, and what are the cash impacted entries. That segregation is very much required. Okay, so going back to the topic of straight line method. So straight line method is very simple, easy to use. Everybody will understand. Depreciable amount into the depreciation rate. You calculate. So now what will happen? During the useful life of the asset, you keep on depreciating this asset. So this year you will debit depreciation charge and credit this. When you go to next year, again you will debit this and credit this. So what will happen? The depreciation will get accumulated in this account. That is the account we call as provision for depreciation or provision for accumulated depreciation. Okay, so these things you have to remember when you look at a trial balance. You should be able to understand what type of an account it is. So the accumulated depreciation will have a credit balance. The depreciation charge pertaining to the current financial year will have a debit. Okay, so let us make a note at this point in time. Please take down. In business organizations, there are several transactions which does not involve cash, cash. Does not involve cash. As a result, these transactions are known as book entries. Known as book entries. Book entries. Okay. And thereafter, in the handout, I have spoken about the advantages and disadvantages. So, if you go through the advantages and disadvantages, I wanted you all to go through same. Were there any difficulty in understanding anything? Because it clearly says it is a simple and easy method, suitable for assets which have a specific effective lifespan, at the end of which the written down value will approach 0. So what do they say there? Now under the straight line method, they say this is more suitable for an asset which, like say, useful life, let's say 5 years. So you start an asset now. Let's say we are in August. So August 2020, right? So when we start August 2020, and we assume that we are a financial year of December, so we come to December 2020. Then we come to December 2021, December 2022, December 2023, 1, 2, 3, December 2024, right? 1, 2, 3, 4. Then December 2025, but now going by the principle, okay, going by the principle, now you have started in August 2020, so your 5 years will complete 1, 2, 3, 4, and the 7 months of this and the 5 months of this. So we will not go till December 25 as far as this asset is concerned, because by this time this asset is fully depreciated. We call it as fully depreciated. So what happens? Now you will have a say cost. Your cost is, let's say, 100,000, and there is no scrap value, no residual value, nothing. Now at the end of July 2025, what will happen? Your accumulated depreciation is also 100,000. Accumulated depreciation is also 100,000, because you will start depreciating from here, and if you will reach by July, it's going to be 100,000. Now, when you look at the difference between cost and accumulated depreciation, which is known as the carrying value, which is known as the carrying value of the asset. At this point, the carrying value will be cost minus accumulated depreciation. So what happens? 100,000 minus 100,000, it becomes 0. So that is what this point is. Suitable for assets which have a specific effective lifespan, at the end of which the written down value will approach 0. So we call this with several names. We can call it as written down value, net book value. All these names are same. Or even we can call it as carrying value at this point. Written down value, net book value, all are same. Or even you can call it as book value. If some exams say book value, that is also same. So if you use a straight line method, it is obvious that you are going to reach 0 by the end of the lifespan. Okay, so I want you to quickly take down this. So I hope you have taken down. Right. So going back to the presentation. So this is the question that we looked at. These are the advantages and disadvantages. Okay. So when it comes to the disadvantage, it says in case the asset is used beyond its effective life, it will be unusual to show the net book value as 0. Right? So what does that mean? Let me explain that also. Now, if you look at it, they say when you go beyond the useful life. Now say this is a, let's say, a computer. So you have used this computer up until July 2025, and you are still using because the computer is in good condition. I'm just taking an example. So if the computer is in good condition, you will still continue to use. But what will happen here? What will happen here? You will not have any depreciation. Okay. So you have to be very careful. In questions, we don't depreciate an asset beyond its useful life. That doesn't happen. That's why I said the asset becomes fully depreciated when the 5 years is gone. It's like where you consume a food item, if it is expired, you don't tend to eat it, right? So likewise, here, when the expiry happens, you don't depreciate. But the difference here is you will continue to use that asset because still the computer is in good condition. All the tables, chairs, everything is in good condition. So I can use it for a further period. Why it happens? Because your wear and tear by using that asset was very minimal, which means you have been maintaining that asset very well. Okay, you have been. So if you buy a vehicle and if you don't do maintenance once in every 5,000 kilometers or maybe say 10,000 kilometers, then the vehicle might give you problems. So if you expected it to be used for 5 years, you might not be able to use it. You might have to sell it or scrap it before that. But if you keep on servicing the vehicle properly and doing all the other stuff on time, the useful life of the asset will be more. Okay? Even though for accounting purposes, we will say it's only 5 years. So during this period or maybe beyond that, what will happen? There won't be any depreciation. But the problem here is, in the financial statements, your carrying value will be 0. That is where they say it's a disadvantage. Because I am not reflecting the fair value. I am bringing the concept, you know the concept of fair value. So if you look at the fair value, actually this computer must be having a value. But due to the accounting that we have followed here, using the straight line method and doing this, this will carry a 0 value thereafter. So that is identified as a disadvantage as far as this is concerned. Then they will also say calculation will not be simple when addition and disposal of the assets are involved. Now say, this is of course a computer, but let's assume this is a building. I'm just looking at a building. Now for a building, what will happen? You started with 100,000, but in between, you will add more and more costs. There will be more and more costs. You might construct a new portion of your building, or you might do changes. A lot of things will happen. I'm saying not those are which are considered to be maintenance, but additions to the building. So those additions again will have to be depreciated. That is where this straight line method will give you problems. Okay, but there are ways and means of doing it. But I'm just saying in general, straight line method will have those complications. Okay, right. So going back to the presentation, now we look at the reducing balance method. Reducing balance method. So, okay, can you read the question, please? Just go through the question. So what does it say? The reducing balance method. XYZ company purchased an equipment for 600,000 on 1/5/2014. So as I told you, we have to always have the timeline. 1/5/14. And they say the cost of the asset is 600,000. Cost 600,000. Depreciation rate 20%. These are all known facts. Calculate the depreciation for every year up to 31/12/2070. So obviously the financial year is 31st December and they want you to calculate the depreciation up to 31/12/2070. Calculate the accumulated depreciation. So it's a matter of adding all those into one, right? So the first financial year is 31/12/14, 31/12/15, 31/12/16, 31/12/17. But actually speaking, this asset will go beyond that. Okay. If you look at the 20% concept, 5 years means it will have to end in 2019 April. 2019 April. Okay, so we are not bothered about that because our concern is up to 31st December 2017. And let us name these D1, D2, D3, D4. So they want you to calculate D1, D2, D3, D4. The problem here is it is not going to be same as what we did under straight line method. Now under straight line method you saw D1 was different, D2, D3, D4 were same. But now it is not going to be the case. That is what the speciality of reducing balance method. Okay. So this company is silent about its policy, which means we have to consider the prorate convention. But the depreciation mechanism will not change. Okay. Right. Now let us calculate the D1. D1 is cost minus scrap value. So cost minus scrap value is 0 into 20%. Okay. Now when you do this, this looks like the straight line method. Yes. In the first year, both will be same. There is no difference. Okay. So 20% means this is the annual depreciation. But our requirement here is to calculate the depreciation for how many months? Any answers? D1 is for how many months? The calculation of D1 will be for how many months when you apply the prorate convention? It will be 8 months. Yes, because from May to December. So this is for 12 months, but I want to calculate only for 8 months. So shall we quickly calculate this? What is the answer? So I think it's 80,000. Correct? Okay, so I'll give you time. So you can take down this and we'll start calculating. That will be easy. So start, take on this and then we start calculating because we have to do it parallelly. So start taking down. So D1 will be 600,000 into 20% means 120,000. 120,000 into 8 by 12 means it is 80,000. Okay. You are following? Right? Now comes the complication with regard to the reducing balance method. Okay, reducing balance method. Now what happens? D2 is not going to be as easy as what we did under straight line method. Now what do you mean by reducing balance method is once you have depreciated this asset in the first financial year, then you have to calculate what is the carrying value of this asset. What is the carrying value of this asset? So let me calculate the NBV1. Net book value 1. Net book value 1. That is at this point in time. So this is where you will end your first financial year. So it will be 31st December 2014. Now as at 31st December 2014, what will happen? Your cost will be 600,000 and your depreciation is 80,000. This is your first year, so the accumulated depreciation will be this. So as a result, you will have 520,000. 520,000. Okay. Now comes the most important D2. D2. Okay. D2. How do we calculate D2 is, now we don't go into this cost minus scrap value. Now it will be net book value 1 into 20%. This is very important. What does that mean is, when it goes to the second financial year, the depreciation is calculated on the net book value. Net book value, when you say net book value, what has actually happened? The original cost of the asset, when you depreciated in this period, it was 600,000. But when you go to the second financial year, it has come down to 520,000. What has happened? The balance has reduced. Now you see why the name is given as reducing balance. The balance is considered to be reduced, so we calculate the depreciation on the reduced balance. On the reduced balance. So when you go further and further, the balance will get reduced further and further. That is what the ideology is. So in the straight line method, every year you apply the cost minus scrap value into the rate. Very straightforward, simple to calculate. But when you come to the reducing balance, it is not the case. This is little bit complex. So what happens here? You take the D1 and you calculate it. So you have a number. Then immediately after that, you have to calculate the net book value soon after the financial year. That will be 520. Then when you go to the next financial year, what will happen? It will be starting with NBV1 into 20%. So which means NBV1 is 520 into 20. So now let us calculate 520 into 20%. Because in this particular year, it is the full depreciation, 12 months. So we don't have to worry about the number of months. So that will give you 104,000. Am I correct? 104,000. Yes. So it's better if you can calculate along with me, so that it will give you an idea for you also. If it's in the classroom, it will be easy for me to know whether you are following, but since we are doing online, you have to be along with me. Then we are required to calculate the NBV2. NBV2. That is at this point, 31st December 2015. So I would want you to calculate now. Calculate the NBV2. Okay, what is NBV2? NBV2 will be what? There are two ways of calculating it. So I'll do the first thing, which is I'm going to use NBV1 minus this depreciation, that is D2. Okay, so which means NBV1 will be 520 minus 104. So 520 minus 104, which gives you 416. That is one way of looking at it. One way of looking at it. Okay? Or you can calculate it like this also. Now, what did I say? Net book value is cost minus accumulated depreciation. Cost minus accumulated depreciation. Okay, you can use any method. I don't mind, but better to know both. Cost minus accumulated depreciation. What does that mean? Cost is 600,000 minus. Now, what is your accumulated depreciation? At this point in time, your accumulated depreciation is D1 plus D2. So D1 plus D2 means, what does it mean? Your cost is 600,000 minus D1 is 80 plus D2 is 104,000. Okay. Now you will see again you will going to get 460. Okay. So these alternative methods, or because sometimes you might get an MCQ where you will have to do it using this method. You can't be going through this process. It will be easy for you to use this. Okay. So in order to calculate the NBV, there are alternative methods. One is you take the net book value of the previous financial year and you take out the depreciation for the current year. That is one method. The other one is you take the concept of cost minus accumulated depreciation and go by that and calculate the net book value. Okay. So accordingly, can you calculate D3? D3. D3. What is D3? D3 is going to be, I will raise this. I don't have space, so I'm going to raise this. D3 will be, you can call it as NBV2 into 20%. Correct? NBV2 into 20%. So NBV2 is 416 into 20. So how much is that? It will be 83,200. 83,200. Okay. So likewise, you have to calculate again D4 also. Sorry, you have to calculate the NBV3, and then you have to calculate the D4. Okay. So that is how you do the reducing balance method. Reducing balance method. Reducing balance method. Right. So let us quickly go through the advantages and disadvantages. It is a simple and easy method to understand. Yes, again, it is somewhat simple. Suitable for assets which have a lifespan exceeding the expected effective lifespan. So that is something different. Now here they say it is suitable for assets which have a lifespan exceeding the expected effective life. Now this is somewhat interesting because if you look at this example, it starts in May 14, okay? Then 1, 2, 3. Then you will come here 31/12/2018. Then you go 31/12/19. Okay. So 1, 2, 3, 4. By April 2019, your asset life is over. Okay, the 5 years is over. In April 19, you can check for yourself. D2, D3, D4 and D5 will be 31st December 2018. So in the period of D6 in April, by April 19, your asset becomes, or the asset's useful life is over. But the problem here is, now you have to calculate the remainder and see. Okay, I want you to calculate D5 and also the depreciation for the 4 months. Okay, when you are at home, like after this class, when you have time, just calculate and see D5 and the 4 months. The asset will not become 0. Like in the earlier case where we said the carrying value will be 0 at the end of the useful life under the straight line method. But here it will not happen. Here it will not happen. Okay. So as a result, what will happen? The assets are more suitable for those kind of assets. Those kind of assets. Okay. Where the useful, the actual lifespan is more than the expected lifespan. And the second thing, if you look at it, the depreciation amount that you are charging is not constant. Not constant. Of course, in the first year, you had 80,000. But thereafter, what will happen? 104,000, 83,200. Likewise, it will go down. So, which means the depreciation at the beginning of the life will be much higher than when you reach towards the end of the useful life. Okay. So, this is another advantage in terms of, because the usage of the asset will be more at the beginning of the life, not at the end. Like even in the human life, we will be doing much more during our good period. But when we are old and we are unable to do anything, nothing will happen. So likewise, the same concept. So likewise, when you are using it more during the initial period, your cost also should be high. Okay, so that they see as a advantage. Then they also say under the disadvantage, in order to bring the asset to realistic values, high rates of depreciation need to be used. Lifespan of assets will be always finite. However, this method implies longer years. So they are talking about this asset, even though we say there is a useful life, but it seems like it is going beyond that. Okay, so that is the concept of reducing balance method. Reducing balance method. Now let's get on to the next method, which is the sum of digits method. Sum of digits method. Right. So what does that say? We'll come to the example, but before that, now we are going to use, now we said that these are scientific methods, but of course it's not Very scientific, but mathematical to some extent. So you would have seen this formula when you are doing O levels or maybe before that. This formula indicates a particular number, depending on the series that you are looking at. Okay. So this factor is going to be used to calculate the depreciation. That is what this sum of years digits method means. Sum of years digits method means. Okay. So here, of course, you don't see any big advantage, but there is a disadvantage of using this because there will be arbitrary nature of weights that you are going to use. Now let's see what this means. What this means. Now, okay. So what does this means is we are going to use, we call that as weights. Okay. Weights. These weights are going to be used for the purpose of calculating the depreciation. Okay. Now, how do we calculate these weights? Is using the sum of digits. The sum of digits is used in various subjects for various purposes. Now here we are going to use it for the purpose of depreciation. Now how does it work? We have something called the useful life. Okay. So let's take an example of 5 years. Now for the 5-year period, we have to calculate what is the sum of digits. So what is the sum of digits? So the sum of digits are calculated using this formula. N divided by 2, n plus 1. N divided by 2, n plus 1. So what does this n here is? The useful life. So if it is useful life for a 5-year useful life period, 5 upon 2 into 5 plus 1. That will give you 15. So the sum of digits for a useful life of 5 years, it will be 15. Likewise, depending on the question, you can calculate the sum of digits for any number of useful life. Okay? This is how the sum of digits work. Okay? So can we take down a note? The sum of digits method is used to calculate a number known as sum of digits known as sum of digits for this depreciation calculation. Depreciation calculation. So you can take down what is there on the board. Below that you can write accordingly, the useful life within brackets you can say n is used to calculate the sum of digits. To calculate the sum of digits. Okay. Right. So now we have calculated the sum of digits. Now let's go to the question. Even in the question it is 5 years, so what we have calculated is same. They say PQR company purchased a computer equipment for 180,000 on 1/1/2016. So it's very easy, I think. On 1/1/2016. So basically this is at the beginning of the year. Yes, because they are talking about 31/12/2017 means it's the 5-year, the December financial year. So they are talking about 1/1/2016 and the cost is 180,000. Okay. And they are asking us to calculate the depreciation for every year up to 31/12/2017 and then so basically my first year December 2016, December 2017, the 18, December 19, December 20. Okay, but our focus area is this is 1, this is 2. Rest is not of a concern for us. Okay, D1 and D2. So now the problem is we have to apply the sum of digits method. How do we apply this? Okay, so the sum of digits method, when you try to calculate the D1, it will be cost minus residual value into n divided by sum of digits. Okay, sum of digits, which is the number that you have calculated. Okay, sum of digits. Sum of digits is the 15. So if that is the case, 180, there is no scrap value, so 0 into n is 5 and the sum of digits is 15. Okay, So how much is the depreciation? 60,000. Okay. 5 upon 15 into 180,000 is 60,000. Then we calculate D2. Now don't get confused with the reducing balance method. Here also it is somewhat similar to the straight line method. But when you go to the second financial year, it will be n minus 1 divided by SOD. SOD is sum of digits. So which means 180, no residual value, n minus 1 is 4 divided by 15. 4 divided by 15. How much is that now? So that will be 48,000. 48,000. So likewise, if you want, you can calculate D3 also. D3, D4 likewise. What is going to change? D3 will be cost minus residual value into n minus 2 divided by SOD. When you go to D4, cost minus residual value into n minus 3. Then next one will be n minus 4. With that, it is over. So D5 would be cost minus residual value into n minus 4 divided by SO. Because when you say n minus 5, it will be 0. So the last one would be n minus 4. So the factor n refers to the useful life. When you say n minus 1, it will be 4, 3, 2, 1. So what is happening actually? There are weights applied. 5 upon 15, 4 upon 15, 3 upon 15, 2 upon 15, and lastly 1 upon 15. This is what known as the weights. This is known as the weights. We said there will be weights used in the calculation. This is the weights. So you can take down this. So we have calculated D1 and D2 separately. That is, the question is up to December 2017. And they also asked us the accumulated depreciation, which means D1 and D2. So it will be 108,000. 108,000. So the remaining D3, D4, D5, if you want, you can calculate. That you can Just calculate and see how it comes. Okay. So here also you will observe, because of the usage of the weights to calculate the depreciation, you will have a higher depreciation in the initial years and a lower depreciation in the final years. You see, 60, 48,000, likewise it will keep on reducing, Okay. Right. So we'll quickly get on to the next one because, yeah. Right. So the next one is the machine hour rate method. Machine hour rate method. Machine hour rate method means in you are going to use the machine hour rate method, as I told you earlier, when there are specific businesses like manufacturing organizations, apparel companies, when they have machinery, because they will be using mostly machinery. So when they are using machinery, their depreciation method, they can use any other method that we already discussed, but it is more suitable when they use this machine hour rate method, because machine hour rate looks at their relationship along with the production of the or what they are manufacturing. So it goes in line with the production and the depreciation. Okay. So if you look at the advantages and disadvantages, it says advantages that at the end of the total number of machine hours, the written down value will reach 0, just like the straight line method. Then they say depreciation is linked to the output attained. I told you how much they produce, the depreciation is linked towards that. What is the disadvantage? The depreciation could be calculated only when the event has occurred. What do you mean by the event has occurred? You will see. Only when there is production, the depreciation will be calculated. Okay. Then they say suitable mostly for machinery, because you can't use this for tables, chairs, computers. It doesn't matter. I mean, there is no relationship. But when you are using it for machinery, yes, because you are talking in terms of production versus the usage of the machine. Okay. So let's go to the example quickly. What does it say? The cost of purchase of a machine was 600,000. It is expected to run 50,000 hours, after which the salvage value will be 100,000. Here we have a salvage value. Okay, you have to be very careful. Calculate the depreciation per machine hour. Now it is slightly different. Earlier they wanted us to calculate the depreciation per year. Now here they say calculate the depreciation per machine hour. So which means now the asset is, cost is 600,000 and scrap value 100,000. Okay. Now the machine is going to last for 50,000 hours, 0 hours, and here 50,000 hours. Unlike earlier, now we don't talk about the financial year or the date of purchase. Those are irrelevant. Here we talk about from 0 hours, this machine is going to be used for 50,000 hours. Okay. So that is the time period this machine is going to be used. This machine is going to be used. They say calculate the depreciation per machine hour. So depreciation per machine hour. What do you mean by that? Cost minus scrap value or residual value, whatever, divided by the machine hours. total machine. So what does that mean? 600,000 minus 100,000 divided by 50,000, because I'm going to use this machine for 50,000 hours. If I'm going to use 50,000 hours, what is the depreciation per hour? So which means 600,000 minus 100,000 is 500,000, divided 50 means rupees 10 per hour. You see, because this is in rupees, this is in hours. Okay, so you will see rupees 10 per hour. Now what do you mean by that? Now earlier we had depreciation rate, useful life, all those, so we calculated some amount in depreciation. Now here it is not the case. Here for the usage only you are going to depreciate. So when you use it for 1 hour, you have to allocate depreciation of 10 rupees. If you use it for 2 hours, 20 rupees. 3 hours, 30 rupees. So what does that mean? It is going to go in line with your production. How long you are going to use this machine for production, then you depreciate the machine accordingly. You don't depreciate it based on some depreciation rate or useful life, because the useful life of this asset is measured in terms of hours, in terms of time. Okay, right? So you can take down this. Okay, so second part of the question is, if the machine was run for 20,000 hours and 18,000 hours in the first 2 years, calculate that. Now they say in the first year, at least end of the first year, right? Okay, end of the first year. How long they have run? 20,000. In the second year, they have run for another 10, which means 30,000. So another 20,000 more to go. Okay, first year, sorry, it is 18,000. Sorry, 18,000. Okay, so here they have run for 20,000 hours. Here it is 18,000 hours. Okay, I'm looking at the cumulative bar. Right. Now we are supposed to calculate the depreciations per those two. So first year depreciation will be, rupees 10 per hour into 20,000. Then the second year depreciation, rupees 10 per hour into 18. Okay, so here it will be 200,000. Here it will be 108,000. Simple as that. So calculation per se, it is very straightforward and simple. Okay, right. So that is all about depreciation methods, and if you refer to any other material that is available on various resources, you might see various types of depreciation methods, but we are not going in detail to all those because those are not actually required for our exam purposes. So these four methods are more than enough, right? So then we are looking at the accounting for assets and depreciation. So if you look at it, accounting for assets, that is when you buy an asset, you will debit a fixed asset account, say motor vehicle account, computer equipment account, furniture account, any account. And you will credit the vendor. Vendor means the person who has supplied the goods. Or you can credit cash. Basically, it is the cash that you are going to. And as you know, now you have been learning to calculate how to calculate the depreciation. So every year when you depreciate this asset or particular an asset, you will debit the current year's depreciation to the depreciation expense account, which is the P&L, and you will credit to a balance sheet account called provision for depreciation. Provision for depreciation, that is the double entry. Then we also looked at something called revaluation. I explained last week the revaluation. So the market value of land and the revaluation mostly applicable for land and buildings. Okay. So the market value of land and buildings usually represents the fair value assuming existing use and line of business. In the case of plant and equipment, fair value can also be taken as the market value. So for buildings, the values are highly volatile. Okay. Now the land prices go up, land prices come down, building prices go up, building prices come down. But other assets, if you look at the computer, furniture, machinery, those are more or less the same. Okay, they go up and down after a long period. So when it comes to the building, yes, the fair value is highly volatile. But when it comes to other assets, it is not the case. Most importantly, when an item of property, plant and equipment is revalued, the whole class of assets to which it belongs to should be reevaluated. That is, if you have buildings in your business, let's say you have about 5 buildings. Okay. Now these 5 buildings are located in different locations. Okay. 5 buildings located in different parts of the country. Now, if you are doing a revaluation, you have to revalue all 5 buildings. Okay. Let me explain it in the board so that you will understand. Now, let's assume that you have 5 buildings. Building A, B, C, D, and E. And let's say I'm telling you that this is 20 million and this is in Kandy. This is 70 million in Colombo 7. This is 30, let's say not 30, 12 million in Gaul. This is 7 million in Kurunagal. And this is about, say, 5 million in Semadar. Okay, I'm just taking it 5 locations and the values. Now I'm going to take you back in a time machine. Let's assume we go back to 2004. 2004, right? So I believe that most of you all know what happened in 2004. What happened in 2004? Any guesses? Yes, exactly. He had that tsunami. Okay, he had the tsunami. Now, when this tsunami happened, you know, this had an impact. This area had an impact. Rest of the areas didn't have an impact. Okay. Now, assume that this company is looking at a revaluation to be done in the year of 2004. Okay, and they do the revaluation also. So in Kandy, this building, when the revaluation was done, let's assume the value has given 23 million. And this Colombo property, he has given, this is 23 million, this is, let's say, 85 million, and this, let's say, 10 million, and this, let's say, 7 million. Okay, so this is how the scenario is now. When they did the revaluation, the value has given values like this. For Candy, 20 to 23 million, so which means the building value has gone up. 70 to 85, 15 million has gone up. 12 million to 7 million here, which means the value has come down. Kurunagala value has gone up by 3 million. Matara value has come down by 2 million. Now, what does this say? Most importantly, when an item of property, plant and equipment is revalued, the whole class of asset to which it belongs to should be revalued. Now the problem is, this is the class of asset. That is building. No? Building is the class of asset. Now when you do the revaluation, you observe the value of these three buildings have gone up and these two have come down. Now for this company, considering these three is advantageous. But when you take these two, it is not advantageous because value has gone down. I have been telling people that my goal building is 12 million worth, but it is now only 7 million. So as a result, you can't ignore this and this when you are doing a revaluation. Okay. Because yes, there was tsunami and these parts of the country were affected heavily. Even your buildings would have got affected. As a result, the value has come down. The value has said no. Value has to be brought down. So because of that, you can't just ignore revaluation of these two and take only these three. That is not permitted by the standard. LKS 16 does not permit you to do that. If you are doing a revaluation, you have to take all. If not, you don't do it in that particular year, you can do it in a subsequent year. But the problem is now the accounting standards are stringent so that normally companies are expected to do a valuation once in every 3 years. So basically, now it has become a must that you do revaluations once in 3 years to make sure that your values are not much variant compared to what you are showing in your books. Okay? Because I have constructed this building or purchased this building at 70 million. I have been using and showing it in the financial statement as 70 million even after 10 years, which is wrong. If the current value is 85 million, you have to bring that 85 million into your books. That is what it means. Okay? So, I want you to take down this. Then, they will have to do the revaluation for all the buildings, all the buildings, all the buildings, irrespective of, irrespective of, irrespective of irrespective of revaluation gain stroke loss, irrespective of revaluation gain or loss. Next paragraph. According to the above example, according to the above example, according to the above example, the company is not permitted. The company is not permitted the company is not permitted to avoid considering the revaluations of Gaul and Mathura buildings. Gaul and Mathura buildings. Since they are having a revaluation loss. Since they are having a revaluation loss. Okay. Then we put a note. Thereafter, a note. Say, recording revaluation gains stroke losses. Revaluation gains stroke losses. Recording revaluation gains or losses of assets. Right. So let's see. Now, in the case of first building, they have a gain of 3 million. In the second one, they have a gain of 15 million. The third one, they have a loss of 5 million. Third one, fourth one, again a gain of 3 million. And the last one, again a loss of 2. Okay. And you know all these are buildings. So if you look at the double entry per se of these buildings, now there is a T account. This T account is for building. And let's say the brought forward value I am looking at in total. So 20, 70, 90, 102, 109, 114 million. Okay. So the brought forward balance of buildings in this company is 114 million. Okay. But now at the end of 2004, what is the value? 23, 85, 7, 10 and 3. So what is the total? 128 million. Correct? Yes. Now actually, as a whole, what has happened? 114 million has gone up to 128 million. So which means this company has an overall revaluation gain. But individually they have gains and losses. Okay, gains and losses. So what do we do here? There is a total gain of 14 million. 14 million. So that we have to record now. What do you mean by that? This 114 million now should reflect 128 million. So which means this has to show 128. So therefore, you need to bring in a balancing figure. You see, now 114 has to go up to 128. So you need to bring in a balancing figure of 48. So you debit here and you credit an account called revaluation reserve. Revaluation reserve. So the 14 goes. Okay. Here you say revaluation. Here you will say building. This is how you account for the revaluation. Now here it was an overall gain. But if you split it individually, what will happen? You will have to put 3 gain, 15 million gain, 5 million is a loss. So you will credit 5 million here, debit revaluation reserve 5 million. Again 3 million gain, we will record it. Again 2 million loss, we will credit here, debit the revaluation reserve. So the gains and losses you have to account for it accordingly. Okay. So this is how the double entry will look like. I want you to take down the T accounts. Please take down the T accounts. So this revaluation reserve is reported in the equity part of your balance sheet. Assets, liabilities, and there is an equity section. In that only you will show this revaluation reserve. So here the 14 million is a gain. Because this is a credit. So any credit coming into revaluation reserve means that's a gain. If there was a debit, then it is a revaluation loss. Okay. Okay, we come to the last topic, which is on retirements and disposals. So before going into that, if you have any questions, please ask now. Okay. So the last section that we need to do in this is the retirements and disposals. So what do you mean by retirements and disposals is when an asset is permanently withdrawn from use or sold or scrapped and no future economic benefits are expected from its disposal, it should be withdrawn from the statement of financial position. Okay. So what does this mean is there are two terms here. One is retirement, one is disposal. Now let's say you have purchased an asset and you have been using it. Okay. So you have purchased it with the intention of using it for 5 years and you have used it. So after the 5-year period, you will just put it aside. Okay, you don't do anything, you don't use it. Now that is called retirement because you don't want to use it further. Just like we work and then we get retired. Okay, so likewise, here also the asset is just put aside without using it. That is retirement. Now the second one is a disposal, which is you use it and then you get rid of the asset. That is either you give it to somebody for a price or for free. When you give it for free, it is called a donation. But if you give it for a price, then it is a disposal sale. Disposal sale. Now that is what we are going to look at. That is what we are going to look at. So I have put down a set of double entries in the next slide, but I would like to explain it through the board so that it will be easy for you. Let's go one by one. Okay. There are three sets of double entries at the beginning, and then there are another two sets later. So we'll go one by one. Okay. Right. Now let's say you have an asset. Right. Let's say you have a motor vehicle. Motor vehicle account. Okay. And you have a balance of, let's say, 6 million. Okay, 6 million motor vehicle. And this motor vehicle has been depreciated. So now you know what is accumulated depreciation is. I don't need to tell you. Accumulated depreciation motor vehicle. Okay. Motor vehicle account. So that will have a credit balance, you know. Let's say it is about 4.8 million. 4.8 million. 4.8 million. Okay. 4.8 million. Huh? Right. So now this company decided, okay, it's for us to get rid of this asset. We don't want to use it further because this motor vehicle is now in a good condition. So no point in using it further. Okay. So you decide to dispose it. You decide to dispose it, and you call for quotations, and 3 or 4 parties would have come, and you decide, okay. You look at the prices. Who is requesting? Who is requesting the higher price? Okay, so let's assume that there are people who have come, and out of that, you have decided to give this vehicle for about 3.5 million. 3.5 million. So you would have bought it for 6 million, but obviously you will not be able to give it for 6 million when you are selling it after usage. So now you are going to give it at 3.5 million. Okay, 3.5 million. Right. Now what is going to happen? You are going to sell this asset and you need to remove this asset from your books. Remove this asset from your books. That is what is important. Okay. So for this purpose, what do? We open a new account called disposal of fixed assets. We open a new account called disposal of fixed assets. Okay, disposal of fixed assets. And using this account only, we are going to remove the asset, the transaction. So what is the first thing that we do? We want to remove this asset from the books, which means I have to remove this 6 million first. Remove this 6 million first. So what is my first objective? I will have to remove this 6 million from this books, means I have to credit here. If I am to credit there, I am going to debit this disposal. So motor vehicle account 6 million. Here disposal of fixed asset account, that is this DEF means disposal of fixed asset 6. It's the first transaction. When you do that, this becomes okay. That is transaction 1. That is what is shown in your presentation slide. Second transaction would be, now if I have removed the cost of the asset, then there is no point in keeping the depreciation also. I have to remove the depreciation also. Now we are talking about the depreciation relating to this particular asset. Not now there can be 5 or 6 motor vehicles, but we are not bothered about that. We are taking an example of one particular motor vehicle. So the second transaction would be to remove the accumulated depreciation. So what do? I will debit the accumulated depreciation, again disposal of fixed asset account, and credit accumulated depreciation 4.8. This is number 2. I am putting this 1, 2 for you all to understand. Later on when you look at it, you need to understand. So first transaction, remember, removing the cost of the asset. Second transaction, removing the accumulated depreciation of the asset. Okay. Third part. Now you have received money, no? You have received some amount of cash. Some amount of cash. So when you receive cash, what would you do? You will debit your cash account, which is 3.5 million, I said. And that is going to come into disposal of fixed asset account and cash account here. That will be your third transaction. Okay, third transaction. So simple. Removal of cost, removal of accumulated depreciation, bringing in the sale proceeds. Sale proceeds. I have clearly said proceeds received, receivable on the disposal. So here you have sold it for 3.5 million. So 3.5. That's it. Now it's a matter of balancing the account. Now the objective here is, when you have done a disposal, end of the day, the disposal account should be made 0. There shouldn't be anything because the asset has gone, so we shouldn't be having anything. So what you will see, 6 million on this side. How much is that? 8.3 on that side. 8.3 on that side. So bigger number is 8.3. And here you will have a balancing. How much is that? That is going to be 2.3. Now what is the 2.3 million? 2.3 million here you are debiting, which means you have to credit somewhere. So that credit is what I have given under the next set of entries with the next set of entries. You will see the first part is when you have a profit on disposal. So you will debit here, credit your P&L as profit on disposal. Profit on disposal. You see? So this is what it means. When you dispose an asset, you can end up either having a profit or a loss. Both can happen. But what does it mean? Whatever it could be, you have to record it as a profit or loss in your books. So what do? We remove the cost, number 1, the transaction number 1, remove the depreciation, transaction number 2, brought in the sale proceeds for how much I sold it, number 3, number 4, calculating the profit or loss on disposal. Okay, so I want you to take down this. Okay, so now this is in the case of a profit. Now let's say you have sold this machine or the vehicle. I'm just raising this. Suppose if you have sold this machine for 1 million. I'm just taking an example. I've sold it for 1 million because I have used it heavily, so I can't sell it for more than that. Only 1 million. Now let's see what happens. If I had sold it for 1 million, what will happen? Let's see. So if you now look at it, 6 million on this side, 5.8 million on this side. So 6 million is more. 5.8. So now what is going to happen? I'll just erase this. $6 million. 6 million. Now when you try to balance it, this side is 6. This side it is only 5.8, which means Your balancing figure is on this side. What is your balancing figure? 0.2 million. So when you put your balancing figure in the disposal of fixed asset account on this side means then you have incurred a loss on disposal. Loss on disposal. So the loss will go to your loss will go to your. Okay. So this is how it works. When it was a profit, you had it on this side. Now it's a loss, it will be on this side. Yes. Right? So you have a loss there. You have a loss there. That is how it works. Right? So you will see I have put down the double entries. These are the double entries. So you know the first three transactions are the transactions that I showed you on the board. Then the first entry thereafter is the loss, and the last entry is the profit. Okay, right. So the next two slides I want you all to just read because it's too early for us to learn what is impairment is. Once we do the impairment topic, we will come back and look at what is this, or maybe you can easily understand this. So thereafter, I have given you a question which is on September 2016. Okay, so I leave it you all for you to try it at home. Now, after you do a thorough revise of what we learned, and then you do this and see whether you can manage this question. Okay, thereafter we will look at this question next week, and then we have to get into the next topic. I have given shared the handout already, that is on investment property. So we will look at that next week. Okay, right. Hope to see you next week. Thanks for joining. Have a pleasant week.